Crypto is wild. One day, you're up 300%. The next, you're down 90%. When everyone's trying to reach the moon, turbulence is guaranteed. But what if you want something stable, something that doesn't ride the crypto roller coaster? That's where stablecoins come in, the Earth to crypto's moon. Built to maintain a steady value, even when the rest of the market goes haywire. But not all stablecoins are built the same. Some are backed by billions in cash reserves. Others? Just lines of code and hope. Today, we'll break down what stablecoins are, why they matter, their different types, real-world use cases, and the latest stablecoin updates as of 2025, including what really separates USDT and USDC. Let's dive in. Section 1. What is a stablecoin? A stablecoin is a type of cryptocurrency designed to maintain a fixed value, usually pegged to a fiat currency like the US dollar or a commodity like gold. Why? Because crypto is notoriously volatile. Bitcoin can swing thousands of dollars in a day. Ethereum, just as bad. But most people need something stable if they're going to use crypto for payments, savings, or international transfers. Example: USDT, Tether, and USDC, USD coin. Both are pegged 1-to-1 to the US dollar. That means 1 USDT approximately equals $1, 1 USDC approximately equals $1. So in theory, you can trade them, hold them, or send them, all without worrying about volatility. But this only works if the peg is maintained, and that's where things get interesting. Section 2. Why stablecoins matter? Stablecoins are more than just a safe crypto. They are critical infrastructure in the digital economy. 1. Hedge against volatility. During bear markets or sudden crashes, traders shift from risky assets into stablecoins like USDC or USDT to protect their capital. 2. Borderless transactions. Sending money internationally? Traditional wire transfers can take 3 to 5 days with $30 to $50 fees. With stablecoins, you can transfer money in minutes, with pennies and fees, even across continents. 3. Cheap remittances. Imagine a worker in Canada sending money back to family in the Philippines or Venezuela. Instead of paying huge fees through Western Union, they can send USDT directly to a mobile wallet for instant access. 4. DeFi and smart contracts. In DeFi, stablecoins power lending, borrowing, yield farming, and staking. Protocols like Aave, Curve, and Compound rely heavily on USDC and DAI as base assets. Bottom line: stablecoins grease the wheels of crypto. Without them, liquidity would dry up and DeFi would collapse. Section 3. Types of stablecoins. Let's break them down into 4 major types. 1. Fiat-backed stablecoins. These are backed by actual dollars or euros held in reserve by a central company. Each token is supposed to be redeemable for one real-world currency unit. Examples: USDT, Tether; USDC, Circle; FDUSD, First Digital, popular in Asia. 2025 update. Circle, issuer of USDC, is preparing for an IPO and is now fully MiCA compliant in Europe. Tether, USDT, remains the most widely used stablecoin but faces regular criticism over the transparency of its reserves. 2. Commodity-backed stablecoins. Backed by physical assets like gold, oil, or real estate. Examples: PAXG, Paxos Gold; Tether Gold, XAUT. These can fluctuate with commodity prices, so while they're stable, they're not immune to market shifts. 3. Crypto-backed stablecoins. These use other cryptocurrencies like ETH as collateral. No centralized company involved, just smart contracts. Example: DAI by MakerDAO. To mint DAI, you lock ETH or another token in a vault. You'll usually have to over-collateralize, e.g. lock $150 of ETH to get $100 DAI. In 2025, DAI now includes real-world assets like treasury bills to diversify its collateral. Other rising stars. LUSD, by Liquidity, fully decentralized, backed by ETH. USDE, by Athena, combines derivatives to simulate a stable peg. 4. Algorithmic stablecoins. These use algorithms to control supply and demand. No fiat, no crypto, just code. Most failed. The most famous? UST from Terra. It collapsed in 2022, wiping out over $60 billion in value and tanking the entire market. In 2025, projects like Athena's USDE are trying again, combining delta-neutral strategies and hedged positions, but the jury's still out. Section 4. Deep dive into USDT versus USDC. Let's zoom in on the two biggest stablecoins in the world, USDT and USDC. USDT, Tether. Issuer, Tether Limited. Market cap, 2025, $110 plus billion. Usage, dominates crypto exchange pairs and cross-border transactions. Chains, Ethereum, Tron, Solana, Polygon, Avalanche and more. How it works. Tether claims every USDT is backed 1-to-1 by its reserves, a mix of cash, bonds, and other liquid assets. However, they have faced years of scrutiny over lack of full audits and opaque reserve breakdowns. Risk note. While USDT is deeply integrated across crypto, its centralized nature and limited transparency make it a controversial choice for institutions and regulators. USDC, USD Coin. Issuer, Circle, in partnership with Coinbase. Market cap, 2025, $60 billion. Usage, widely used in DeFi and preferred by institutions. Chains, Ethereum, Solana, Polygon, Avalanche, Arbitrum, Base. How it works. Every USDC is backed by cash and U.S. treasuries, held in segregated accounts at regulated U.S. financial institutions. They publish monthly attestations, and are considered one of the most transparent stablecoins. 2025 update. Circle is set to IPO. USDC is compliant with both US and European regulations, including MiCA. It's increasingly accepted in fintech apps, remittance services, and even bank integrations. Section 5. Risks and regulations. Even though stablecoins offer powerful benefits, they come with serious risks. Centralization. If the issuer gets hacked, sanctioned, or shuts down, your coins are toast. Depegging. When reserves aren't fully backed or redemption isn't possible, prices can break below $1, creating panic. We've seen this happen with smaller stablecoins, and UST was the ultimate cautionary tale. Regulations. Governments are catching up. EU's MiCA regulation limits stablecoin use in payments. Requires licensing and full asset backing. Applies to any issuer offering stablecoins in Europe. U.S. stablecoin framework, pending 2025. May require stablecoin issuers to register like banks. Pushes for full transparency, segregated reserves, and redemption guarantees. Conclusion. Stablecoins are the backbone of the crypto economy. They're faster than banks, cheaper than remittance services, and essential for DeFi, trading, and global transfers. But remember, not all stablecoins are equal. Stick to transparent, regulated, and widely adopted options like USDC, trusted, compliant. DAI, decentralized and growing. FDUSD, emerging force in Asia. USDT, powerful but controversial. Final thought. Whether you're a trader, a developer, or someone just trying to send money home, stablecoins can offer a better way. Just be sure to do your homework before you click send. Do subscribe, click like, share if you find this video helpful. Let us know what you'd like us to cover next.